Hello and welcome to Market Domination. I'm Julie Hyman. That's Josh Lipton, live from our New York City headquarters. We are giving you the ultimate investing playbook to help tune out the noise and make the right moves for your money.
And here's your headline blitz, getting you up to speed 1 hour before the closing bell rings on Wall Street.
I think they've got a really hard path in front of them. And that's the problem you get into when it's chaos. And that's what it is that the President of the United States has created. You know, this is the dumbest trade war in history. And this is a potential recession created not because we had years of building up risk in the financial system as we did in 2008. Instead, this is one person creating enough chaos that it may bring down not just the American economy, but the worldwide economy.
I think we're set for a real shift in company guidance this quarter. I mean, at the beginning of the year, we were quite optimistic on the outlook for mid-double-digit earnings growth and quite broad-based earnings growth as well. But now I think what we're going to see is a likely broad-based wave of earnings downgrades and a lot more caution in company guidance moving forward.
Well, I think one of the big surprises from these tariffs is that actually the US equity market might be hurt most by this. And one of the reasons for that is because the nature of the US tariffs mean that a lot of the US corporates can't use these things like dual source supply chains or even substitution to try and navigate some of these increasing costs.
We got 1 hour to go until the market close. Taking a look at the major averages, we continue to ride the tariff train, by which I mean every little tariff headline or speculation or report causes reactions in the market. We started the day higher. We are now lower on all three major averages after the White House confirmed that the China tariffs that are set to go into effect tomorrow on that country specifically are 104%. When you add up the tariff, the retaliatory, the retaliation for the retaliation, you get 104. Market doesn't like anything that shows more sort of hawkishness or aggressiveness on tariffs. So we got the Dow trading a little bit lower right now. The S&P 500 down 0.6%. The NASDAQ down 1%. And just switching it on over real quick, I'm going to ask you to touch the screen there.
What do you need?
Josh, hit Apple.
There we go.
Apple,
wow.
Really the one that sort of took this the hardest, down by more than 4%. There was a report yesterday that it was going to move some of its production to India.
Yeah, well, and by the way, Apple has now been just shelled. I mean, this is a stock that's now down about 30% year to date. Our friend Dan Iser at Wedbush, Dan's still bullish on this name, outperform, but he recently said, you look at that name, that's the eye of the storm of tariffs. I would argue it's not just Trump tariffs. I think if you're an investor in this name, you're also wondering how and if China actually responds, takes on a big American brand. To your point more broadly about the market, yes, it looks like the U.S., Julie's going to move ahead with these tariffs on China. It's also important, China is talking very tough right back. I mean, China does not seem like they're backing down. So you have this same basic fundamental issue of policy uncertainty. I think for investors, they're kind of wondering against that backdrop, whereas you rightfully point out, policy uncertainty, you're following every tick of headlines. You're wondering to an investor, are there negotiations? Are there deals? What do the deals look like? What's the timeline of the deals? Against all of that, can this market actually put in the bottom and move higher? We have some smart people we can ask that today.
We do. A couple other things I want to check on. As we talk about China, let's take a look at the Chinese stocks. They are not doing well. It's very difficult to find green on this screen. These are the China stocks that trade here in the U.S., likes of Alibaba, PDD, NetEase, Jetty, JD.com. All of them are trading lower. And then to go back over to different asset classes that I just want to mention quickly for a moment here. You got to be watching what's going on, both in volatility, that's crude oil volatility, pardon me. Here's the VIX. We'll get there eventually. The VIX continues to go back up here today as we saw stocks go down. It's at 49. I wanted to check on what's going on in treasuries, where we continue to see yields move upward, countering the earlier downward move we had seen, and sort of a little bit mystifying in this environment that we're seeing people come out of treasuries, and then crude oil continues to really take a hit here as well, below $60.
There was one other storyline which I think is important today, which is the drama inside this administration and the very public fight that has now broken out between Elon Musk and Peter Navarro, and Musk is on X calling Navarro a moron. And I don't think it's just drama. I don't think it's just soap opera. I think it's another question mark for investors. You had the White House press secretary who was saying, well, it's two guys, two very different opinions about trade and tariffs, and that's true. And then I think as an investor, you think, if that is true, and it certainly looks to be, Navarro, trade advisor, Musk, CEO, businessman, who has the president's ear? Who has his confidence?
Yes.
It's just more questions as an investor you have.
Well, and I think she also said, but this is a very transparent administration.
Right. It is transparent, which raises questions, right?
It's like, maybe we need a little less transparency. Maybe these negotiations need to happen and just come to us when things are done. And you don't need to fight in front of everyone.
Or on X, yeah. For more on the latest market moves, we want to welcome in Mark Newton now, Fundstrat Global Advisors, Managing Director and Global Head of Technical Strategy. Mark, it is always good to see you and to have you on the show. So maybe start big picture here, Mark. I was just talking to Julie. Let's talk about the S&P 500. You look at the charts, you look at the technicals, Mark. When you look at the broad gauge here, what do you see ahead, near to intermediate term, Mark?
Well, thank you, Josh and Julie. In the short term, there are some reasons to suspect that the S&P is going to be nearing a low, and that could be happening within the next week. We have seen classic signs of really a washing out in breadth, along with extreme volume to the downside, and most recently in the last couple of days, volume also to the upside. Normally these type of patterns are really, they coincide with markets starting to bottom out at a time when we saw, the percentage of S&P above their 50-day moving average got down to single digits, and that's very rare indeed. So, in my view, it's going to be a little bit of a tough sled because the momentum has gotten so strong to the downside over the last 7.5 weeks, and we're down about 21%. And so we have a lot of metrics where percentage of S&P hitting new 6-month lows is higher than we saw even back in 2022 at the height of the bear market after being down almost 40%. So, it's my thinking is markets should bottom in the near term. It should be less because of necessarily tariffs. I mean, I think we all need to understand the characteristics of what led to the breakdown of the monetary, the order itself of what's really truly happened in recent months. And it's less about specifically what Trump did, but what really led to the country voting for that and for the tariffs itself. And so the underlying cause of that will sort of help to explain sort of some of this divisiveness and really where we are today. But a very difficult time. Certainly most of us would choose to do things probably a different way in how we implement that. The key is now, how do we look back? How do we change what's happened after all these tariffs have been implemented very, very quickly? We need to see some evidence of some negotiation very, very quickly, or else I think it will start to lead to that softening of the economy, start to lead to potentially the hard part of the economy turning down. We can't say that now. I mean, the economy is still honestly in very good shape, despite the bear sentiment. Sentiment has gotten off the charts bearish, but yet there's still some reasons to be optimistic about the economy and also about earnings. I mean, technology is very reasonable now from a valuation standpoint. It's still going to be the number one driver of earnings growth this year in 2025 at about 25%. So now technology is honestly cheap, and we're seeing everybody say, well, it's time to take money from the U.S. and go abroad. And I would argue that it's honestly time to consider the opposite after about 4 months of U.S. underperformance. The U.S. is still going to remain the strongest country in the world. There are 20-year uptrend lines of the U.S. versus the All-Country World Index that remain in very good shape. And so I'm skeptical that it's time to get out of the U.S. for anybody longer that has a time frame longer than a few weeks. Certainly a rocky time. My cycles bottom out in April. I think we rally from April into the summer. If we can't have a strong rally that really helps to show broad-based participation and volume on the upside, then markets would be vulnerable to a further drawdown in the fall. Right. And I can't make that comment now, but I'm unwilling to say we're in a traditional bear market like what many would say. I mean, the fixed income dislocation has been quite minor. We've seen spreads blow out a little bit in the last couple of days, but it's still pretty orderly. Like CCC spreads are at the same levels we saw last August. So it hasn't been this fixed income dislocation that's caused this unraveling of the market, more so a growth scare, people wondering about inflation. At the same time, many of the inflation metrics are starting to nosedive. The break-evens are down. We see crude oil cracking $60, which likely is going to head to 50, if not 40. That's going to be a huge deflationary force, along with just the lack of any understanding about the demand coming from China.
There's a lot in there to break down. Right. So I'm just going to focus on the sort of short term here and ask you a question about that, because I know you don't necessarily think we've reached a bottom, but we're in sort of a process of finding the bottom. Can the bottom be found while the tariff headlines are still hitting in the way that they have been?
I think they can. If you look at yesterday's lows, I mean, we rose about 10% off those lows with really no meaningful news. If anything, there was negative news regarding a potential escalation of the global trade war with China. So there's rarely good news that happens at bottoms. That's an important lesson. And also, there's not bad news that happens at the peak of markets. Normally, markets can bottom out for two reasons. Either there's a drying up in volume on the downside, or there's real capitulation. And arguably, we've started that process of capitulation. High put-call ratios above 1. We see the VIX now in the mid-50s. The term structure inversion between spot VIX and 3-month futures is about 20. That's extraordinary. So it's tough to say, well, this news is going to cause the market. We're in a tremendously volatile time with the VIX in the mid-40s. News is going to it's going to be very difficult to explain a lot of the price action just given the kind of volatility right now that we're seeing.
So Mark, we put in, how you would characterize it, we put in a low, but not the low. Is that how you would put it?
Yeah.
As a technician, I'm curious, what are the indicators you look at that would suggest to you okay, maybe we did put in the low at some point?
So I've seen a couple of them already that have sort of checked the boxes I look at with regards to sentiment-based and also the start of some volume dislocation on the downside. The Goldman's prime brokerage desk said we had the greatest level of shorting last Friday that we've ever seen. So there's clearly now a level of selling that we haven't seen in some time. I want to see a dislocation of the volume, much more volume on the downside. We started to see that earlier on this reversal where the trend of the ARMS index gets up above 2. So extreme selling is important to marking bottoms. I think we're very, very close. The S&P, by the way, 4,800 is the 50% ratio of the entire move up since 2022. It's very important technically. It also lines up with the prior peaks that were put in back in January 22 at the height of the bull market. There's a lot of things to suggest S&P should be nearing a low. Technology is down to pretty good support. Many of these companies have been washed out. We saw the S&P, there's only 2% of all S&P companies that are above their 20-day moving average. That's historically very, very extreme to the downside. So it's sort of hard to press stocks down even though we're free falling, but everybody's wondering what's going to make the market go up. It's like you try to putt a golf ball down a flight of marble stairs and tell it to stop and go back up. There's a lot of momentum right now.
Yeah.
It's very difficult to say, what's going to, I think we ought to leave, picking bottoms to the proctologists because none of us are very good at it.
I think that marble step thing might be the best explanation for technical analysis I've heard. But I want to ask you about technology stocks for a minute because you said a moment ago you think rather than putting all your money in international right now, maybe reinvest some of it in the U.S. Is it time yet to do that? In other words, if you are waiting for your entry point within large cap tech. And is it dangerous to do it before earnings season when we might have some of these companies say, for example, I'm not going to even make a forecast?
It's a great question, Julie. And look, danger has all to do about one's time frame and risk tolerance. So if you have a time frame of 2 to 3 weeks and you can't afford to lose 10% or 15%, it's right to stay on the sidelines until we stabilize. For those with a longer term perspective, I think it's an excellent time to get into technology, honestly, right now. We've seen the Mag 7 come down substantially, and as I said earlier, the valuations are now much more in line. Some of these companies are cheap, and they're making a tremendous amount of money. They've all changed our lives for the better. It's important to look at technology as being what it is. It's not going away anytime soon. The key is, does the tariff news cause these companies to all retreat and pull back so dramatically on their spending that it could cause a rolling over? I don't think any of us have any insight as to that. We know Trump as being this transactional type president, right? Art of the deal, you scratch my back, I'll scratch yours. This whole thing, unfortunately, is a game which has dramatic and unfortunate consequences to risk assets in the near term. We still have $37 trillion in debt. $10 trillion of that needs to be refinanced this year. So we've seen over 100 basis point drop in interest rates. That's going to save the U.S. hundreds of billions of dollars. That's actually a good thing that nobody's talking about. But obviously, it's unfortunate. Nobody wants to see the stock market go down, wonder why he chose this path. I'm hopeful that China and Europe, we can find some arrangement, but call me cautiously optimistic for the market over the next 2 to 3 months. After that, we need to see a lot to think that we can repair all the damage that's been done, that S&P can get back to new highs.
Yeah. All right, Mark, thank you so much for coming in.
My pleasure.
Good
Thank
to see you.
Likewise.
Well, President Trump's tariffs are sending markets on a roller coaster ride, with long-term Treasury yields also displaying peculiar trading, some might say. Here with more Yahoo Finance's Alexandra Canal. This is something that actually Mark just alluded to when we talked about earlier. Treasuries had yields had come down a lot. But over the past couple of days, we've seen an increase in yields.
Increase in yields, and this really started at the start of the week. The 10-year Treasury yield jumped 17 basis points on Monday. This was a massive 34 basis point swing. We extended those gains today. We're up about 10 basis points just today, hovering at around 4.25%. Same thing with the 30-year yield, jumping another 12 basis points. We're currently levels there at around 4.72%. Now, as a reminder, bond prices and yields, they're inversely correlated. And so we're seeing this heavy selling in the bond market. And what's really interesting is if you talk to a lot of strategists out there, they don't exactly know why. And Wall Street has laid out a few different scenarios. One could be this rush for liquidity. Perhaps there's some selling to have some cash on the sideline. Another theory is perhaps bond traders are pricing in higher inflation due to these tariffs. We just heard from the White House they are going to be implementing 104% tariffs on China at midnight. And if inflation is going to be high over the long term, the Fed is going to maintain a very restrictive interest rate environment and therefore push up yields. But what's made this a little bit more complicated is the stagflation risks of it all. And I just talked about the inflation part of stagflation, but if you focus in on the stag part, slowing growth, that implies that we could potentially have a U.S. recession. And we've seen several Wall Street firms come out and talk about the possibility of a recession increasing due to these tariffs. So that's initially, Julie, what you said. That's what we saw in the aftermath of Liberation Day. Perhaps we're entering a period of stagflation that could lead to a recession and yields will come down. But now we're just seeing this uptick and this rise, and there's not a true catalyst as to why.
Well, you know what? We have somebody on set who
I would love to get your opinion, Mark.
And that's Mark Newton, who's still with us on set from Fundstrat. Mark, you've been hearing what Ali is talking about. I know you've been watching the bond market as well very closely. What's going on these past couple of days?
We have seen a slowdown and a pretty dramatic reversal in treasuries in recent days. My take is that it's going to prove short-lived. I don't see any real catalyst for why yields are going to escalate that dramatically. So, you could potentially move up for another couple weeks. The rise in the interest rates, honestly, is also directly coinciding with a big pullback in the precious metals, and that's something that people should take a look at also. That's going to create some opportunity. My cycles show yields steadily falling between now and really the fall, so I think 10-year is going to get down to 3.5%. It doesn't have to be because of necessarily growth falling apart. It could be because inflation is really starting to come down much more quickly than people anticipate. And you've seen that steepening on the yield curve. The 2-year is really coming down dramatically, and I think that's also interesting. Tough. I'm not a big bear on treasuries here, but I do think at this point, they've already outperformed equities so much. It's right to actually favor U.S. equities and get out of that 60-40 and more into equities if you have a time frame of, say, 2 or 3 months. I think we're going to see the road, it'll be a little choppier now for treasuries after such a big decline in yields over the last 6 months.
And Mark, I want to ask you a question too, because we spoke with Steve Sosnick, friend of the show, he's from Interactive Brokers. He laid out another interesting theory that perhaps with all the back and forth of China, there's a possibility that China will stop buying our debt, that they will boycott our debt, and how that could potentially impact the demand, because then the U.S. Treasury is going to have to raise the yield to sort of make up for that loss. Right. Is that a risk at all?
I think it's certainly a risk. I don't know that can be immediately said as something that's going to happen right away. Those kind of things happen gradually over time. But, we've heard stories of that kind of thing happening. I think China is an interesting story. I mean, we've seen such a big rally off the lows. China is extraordinarily volatile. We know they have material problems with regards to M1 falling, the lack of demand, the tariff. Even the perception of tariffs is really going to spook China, I think, for the months to come. That's one of my reasons why I think crude oil drops so sharply. China is very important to the global demand picture, so that's something that needs to be worked out right away.
All right, Mark, Ali, thanks so much.
Thank you.
Thank you.
We're just getting started here on Market Domination. Coming up, while tariffs have rattled markets as of late, we'll hear from one analyst who says they actually offer one silver lining, perhaps, for tech stocks. Stick around, much more Market Domination still to come. According to our next guest, market-rattling tariffs maybe offer one upside. Companies can use the shifting financial landscape to adjust their performance goals, calling the current macroeconomic uncertainty a free hall pass for the tech giants. Joining us now is Brent Thill, senior analyst at Jefferies. Brent, There's a lot of negative stuff to say, so I thought I would start with something a little bit more silver lining-ish, I guess, a silver lining of a sort, which is that maybe this whole situation is air cover for companies to say, okay, we're not going to give you a forecast or we're going to reset things. What are you expecting to hear from big tech as we get into earnings? Brent, you hearing us okay?
If CFOs keep guidance, if companies keep guidance, we're going to effectively see stocks go lower. So what we're advocating is most tech companies just guide to more conservative outlook, and investors want to buy that dip, right? We have many of these tech stocks off 20 to 40, 50% in some cases. So CFOs have a hall pass to lower the numbers. Institutional owners have seen multiple compression. The only other thing that can compress are numbers. So effectively just take a haircut to some of the numbers, and you effectively will have a better backdrop for tech investors to want to buy stocks. So one of the things we keep hearing back from institutional investors is, I got to hear numbers going lower, maybe CapEx a little lower, and I feel more confidence that I can buy this dip.
Brent, I would assume, given the very smart, grizzled financial analyst that you are, Brent, that you are doing your checks on your own companies. You're out there doing your field work. Generally, what are you hearing, Brent? Are you hearing, is it caution? Is it raw panic? How would you describe it?
More drama than the ending of White Lotus. So it is pretty gnarly. And what I'd say is, like, you hear things all over the board. Some are not seeing it yet. Some are saying it's coming. We had one advertiser say that he expects kind of everything to kind of grind to a halt in the middle part of the year as advertising budgets can turn off. So, he saw 15% growth at meta budgets last year. He's seeing 0% growth this year. So, I mean, it's kind of all over, and it's what you would expect, which is we haven't seen it yet. It really didn't have a huge impact on Q1. It has a bigger impact in Q2. Then the question is, like, what's the range of the tariff outcomes? And I think that's the thing none of us know. And so because we don't have any certainty, everyone's waiting to see and waiting to buy post-April, May earnings. And most of our clients are doing nothing right now. They're not buying, they're not selling, they're just waiting. Now, if you ask our tech desk, 50% of the pain has been felt. And so we still feel like there's more downside. We cut numbers across the board Monday across 30 software names, and then we ran trough multiples, and that suggested at the midpoint another 15% downside as of Monday before the market. So I still think right now we just don't have a lot of conviction. But I think, again, we're getting nearer, hopefully, in the second half of this pain versus the front half. And again, I think that's good.
Yeah, you called it in a recent note a mullet year, business in the front, party in the back, I guess. Like the second half of the year could be better. What's going to fuel that better? Is it that you're going to see these companies cut and have that reset? Is there actual good news coming down the pike, or is it more an absence or alleviation of bad news?
I think you have three things. You have multiple compression already, so that's good. That's gone. That's already getting put into these stocks. Second is you get number cuts. So we get number cuts and multiple compression. That yields lower price targets on stocks. We've already done that across the board. Getting the rest of the street to take numbers down, right? We saw a couple other tech firms bring numbers down across the internet today. That's healthy. So everyone's just got to keep taking numbers down. I think the tariff component, which is, how hard is the government going to back off? At some point, everyone knows we were going to go in hard. And I think everyone we talk to in the political field says that there's going to be a softening. No one really knows to what degree. And then how long does this sit? I mean, I guess I was surprised to see, 3 days of golf post all these issues. I think everyone was shaking their head, like, doesn't seem like there's any urgency to want to back off from what we saw. So I think it's kind of what most strategists felt like, which is we'd come in hard, and then it's really just it's a macro driven now for tech. And so we're all having to put our macro hats on, and we're taking our tech hats off.
Brent, when you're talking to clients right now, if they ask you, all right, so break it down for me, what are the names that you see as, relatively defensive, large caps, favorable risk reward here? You tell them what, Brent? What would be some examples?
Meta, close to, a low on multiple. Microsoft, high recurring revenue. No corporation's going to cut their Microsoft spend based on what they're seeing. And look, no one's immune, so I don't want to sit here and say anyone's, going to fly through this. But many of these stocks are off. I mean, Microsoft's off 15%, right? Amazon's off 22%. So we like Amazon here in terms of the durability. You're still going to buy deodorant and shampoo. You may not go to the Masters this year because I heard the tickets doubled from Monday to today. So that may not be happening at the end of the week like I thought. So you're still going to go back to basics, right? And I think we're seeing, those names that provide those basics around their cloud compute, around core components that drive our households and business environments. Amazon should be in a better spot. And again, it's already taken a big brunt of the hit. I like the bigger platforms. I like the large caps. I think the small and mid caps, I mean, we could have way bigger variations on outcomes because they don't have that type of durable mosaic of portfolio across the globe. So yeah, I mean, that Amazon's at risk because of some of the tariffs, but ultimately you are going to trade down. You're still going to buy the basics. So I like Microsoft, Meta, Amazon, and then in mid cap, I'd highlight some of growthier names. Once this clears, companies like Monday.com, MDNY, and then Procore, PCOR. They power the global construction industry, infrastructure, roadways, power plants, sewers. They're still going to get built. And Procore is the collaboration software that enables the construction world to come together and build this effectively. And the last name I'd say is Roper, ROP. One of the best management teams. I've said if my kids went to spend the weekend with the CEO, they come back better than if they hung with me. I'm a huge believer in the management and the quality of this franchise. It's 28 companies in one that you owning one stock, which is ROP.
One more question, kind of come back to the reset that we might get from these companies, specifically with regard to spending. All these big infrastructure, AI spend plans, CapEx spend plans that we heard about earlier in the year. Do investors want them to cut those? Is that a good thing or a bad thing? Do you think they're going to be cutting some of those plans?
I mean, it's still an AI race, and we were just at an Oracle data center in Salt Lake last week, and they can't get enough supply of products, and they can't build the buildings fast enough, or can't get the energy fast enough. I think some of these Microsoft cuts are not just because AI is done, it's just they're optimizing where their dollars go, and I think that's smart. And maybe they have an indication that the economy is starting to soften. And so I think everyone's been freaking out. If Microsoft cuts, what happens? And cash flow is going to go higher, right? We've been in a massive CapEx spend environment. So if you're a software investor, you want CapEx to be cut. If you're a semi investor, you're running for the hills if CapEx gets cut. Right. And so I think it depends on where you're at in tech. I'm a software guy. I think everyone wants CapEx cuts to start. I think I've said this repeatedly. Microsoft and others are starting to pull back the throttle a little bit. They publicly indicated they're not going to be spending as much next year as they did this year. And everyone's freaking out on every data point right now. So I think it just tells you everyone's in these names. We're too overweight on some of the infrastructure. Everyone's been in AI infrastructure. I think this AI trade goes to software. So a CapEx cut would be good for software. It would not be good for anything in infrastructure. So look, the problem is Meta just raised guidance in CapEx. We got a raise from all the others. Our CapEx went from $300 billion to $350 billion. And so the only one I see right now really pulling back is Microsoft. They publicly said that it's going to go, CapEx will equate revenue growth and not grow at 97% like it did last quarter. Mm-hmm. So I think overall, yeah, it depends on what side you're on in tech. It's really scary if you're an AI infrastructure vendor if these guys pull back, because those stocks are going lower if they do.
You know the headline for me out of this one? Brent Till, it's gnarly.
It's gnarly.
I think that's
for me, it was more drama than the White Lotus finale.
Also, sub-headline. Very well. Brent, always good to see you, my friend. Thanks for joining us.
Yeah, thanks for having me, guys. Take care.
The stock market struggling to hold on to gains amid fears over tariff risks. However, our next guest highlighting an underappreciated winner of this geopolitical year. Vitafi Senior Research Analyst Zeno Mercer joins us now to discuss. Zeno, great to see you on set.
Great to be here.
So let me ask you, Zeno, so we were just talking to Brent Till there. I want to stick with, listen, Trump 2.0, tariffs are front and center. I want your line of sight about what that means for one sector that you know very well, Zeno, in particular, which is robotics, right? How should investors be thinking through puts and takes there?
Yeah, I think it's good to look kind of back at the last 5 years. We've seen the global robotics market was in a contraction or flat. we're not seeing growth. We saw China, which is 70% of industrial robots, that's starting to decline. We'll see how everything shakes out this year. So we saw end markets tough. We saw U.S. construction for manufacturing at a record high of about a 200 billion run rate. So we're seeing all this capacity built up. And these are actually from Biden policies with the CHIPS Act, Inflation Reduction Act. So we were already leading with a bunch of carrots there. Now with the latest, we're kind of turning carrots into sticks and whacking people that were already investing. So like, speak softly, carry a big stick. Now we're smacking around with a carrot. A bunch of companies that were already investing a lot of money into CapEx and stuff in the US. Like you have a lot of Japanese companies that are going to be front and center with global reshoring, global nearshoring, and like an industrial rebasing of localized infrastructure build out. They've been hit really hard year to date, both from a tariff front and also, an expectations of investment front, which is ironically, I'm sure, kind of the opposite intent of where we're heading.
Right, and even some of those that have done the reshoring, if they're importing aluminum or steel to build, to make the robotics components, they're going to be tariffed on those items.
Exactly, which is why it probably won't. Like, I don't see a world where that actually sticks, because if you actually do want to build stuff in America, you have to get the inputs down. I mean, I saw today that lumber was bumped up, so now construction's, going to go down. Like it's just, economics and physics. But again, from the longer term picture, this kind of reminds me of where NVIDIA was at in 2022, where we saw PC and gaming going down, but like the bigger picture was like there's this big wave coming. And right now, if we kind of think back what's happened this year, we had DeepSeek, we had Stargate, we had NVIDIA at GTC showing a bunch of new robotics modalities, simulations, and humanoids, right? So if you think of like where are we heading, if we kind of ignore like the fray for a second, like the bigger macro picture is that, we're looking at the end of 2 years of really tough robotics market, but we're looking at the dawn of a new super cycle. And it's not just a trend, it's not a theme. This is where, if we're gonna reshore anything in America, probably gonna be more high-tech stuff. It's gonna be very advanced manufacturing. We're not gonna be doing shirts, socks, things like that here.
So when Trump talks about this broad policy goals, making more stuff here, right? Produce more here. As you think about what that actually looks like 5 years, 10 years and beyond, you see, okay, we're making more stuff here, but it'll be more stuff made by robots?
Yeah, probably.
Yeah.
And then how do you invest in that?
Yeah, well, I mean, you've got obviously like your picks and shovels. You've got US robotics companies, you've got companies in the system integrator. So how do you plan and build out both up front and ongoing? So companies like Rockwell, ABB, and Siemens. You have Japanese players that have been at the forefront of manufacturing, like Fanuc, that have already invested a lot in the US. Like this has already been their biggest push area, like to get less dependence on China. And then, even companies like Foxconn, right? This is Apple's biggest partner. There's two things happening with them that's interesting. They're doubling production of iPhone capacity in India. That was announced and planned recently. But iPhone's not even going to be their biggest area. They've got AI servers, so they're partnered with NVIDIA. They're getting into EVs. They're geo-diversifying. So they're also, if you think of relative valuations, the U.S. market has been pretty expensive lately on a relative basis. Foxconn has been trading at under 9, or right now they're under 9 times forward EV or PE and 0.3 times forward EV sales. So you've got, not only opportunities here, but you're looking at historically relatively low and pretty much absolutely low valuations.
So, always good to see you, especially on set. Thanks for coming in.
Thank you.
Coming up, some big banks set to report earnings this week. We're going to tell you everything you need to know ahead of those reports and how to be best positioned within the sector. Stick around, much more market domination still to come.
Now time for some of today's trending tickers. First up, CVS, then Boeing and Wayfair. Let's start with CVS. That stock was jumping today. Let's make sure. Yes, it's still jumping. We've seen a meltdown in the market overall. CVS, though, is still higher after the pharmacy chain said it expects to meet or exceed its previous outlook for 2025. The company also made some management changes. David Joyner, who became the CEO back in October, named a new CFO here, and the company has also named a new executive vice president and chief medical officer. So it seems like the market reacting to a couple different things here.
Yeah, I see the change in the C-suite. So former UPS CFO Brian Newman takes over. It looks like effective April 21st. Looks like some positive commentary. I do see analysts at Larinx side is saying this will be helpful to address the complexity of the company's broad enterprise. Also did name a new, looks like executive VP and chief medical officer. So on a down day, this one's popping here.
Yeah, and Walgreens also, by the way, in the same business, coming out today and beating in terms of its numbers. Of course, it's not going to be public for long.
Sycamore.
It's being bought by Sycamore for $10 billion, which is going to close by the end of the year. But really, all of anything in health insurance that has Medicare and Medicaid, Medicare Advantage exposure has been rising today. That's because the Center for Medicare Services came out after the close yesterday and announced its new rate structure for next year. And it's a little bit more of an increase than was estimated. So that's something underlying all this. It's also
it did look like their healthcare unit was a positive.
Right,
in that
exactly.
report.
So related.
Our next trending ticker, let's check out Boeing here. That stock also moving higher in today's trade. It's after the company announced it delivered 41 jets in March. That was up from 29 during the same month a year ago, though the figure was slightly lower than the 45 handed over in January and 44 in February. So listen, 41 jets in March. That was the best 3 months since the final quarter of 2023 per Bloomberg. Remember, Airbus scheduled to report its monthly orders deliveries on Wednesday. Listen, for Boeing 2024, we know rough, obviously, the strike, other issues. Now dealing with tariffs, possible ripple effects there, questions about China. But good report today.
Good report, but the stock isn't higher anymore. It was higher, now it's dipping a little bit lower along with the rest of the market. And by the way, we're going to get Airbus deliveries tomorrow, I believe, so we'll see how Boeing did versus its largest competitor, I should say. And also, our next trending ticker is Wayfair. Those shares lower today. Bank of America lowering its price target on the stock from $41 to $33, citing the impact of tariffs on prices. Now, this was a part of a bigger report that looked at sort of internet, e-commerce, furniture retailers, but in terms of Wayfair specifically, the analysts over at Bank of America are also sort of comparing this tariffs this round versus tariffs that we saw during President Trump's first term, and saying this time is going to be a harder slog.
Yeah, on the home furnishing industry, they talk about, listen, highly exposed to tariffs. History indicates price increases could risk volumes. They say in the current form, we believe tariffs would be very difficult to manage. And they say we estimate consumer prices would have to increase by potentially 30% plus to offset higher costs.
Yeah, and in terms of Wayfair specifically, they say EBITDA could likely take a hit because of lower volumes as we see the tariff follow through, but further operating expense cuts could limit the impacts.
Yeah, other names, they talk about RH, they say could see significant hit to earnings from tariffs. They talk about Etsy, they describe as relatively well protected, but still see risk to GMS growth, so gross merchandise sales.
Yeah.
All right, as banks begin to report earnings this week, investors' focus will likely shift from profits to CEO remarks on the economy after President Trump unveiled steep tariffs and triggered a market sell-off. Joining us now is Stephen Bigger, Argus Research Director of Financial Services Research. Stephen, it is good to see you. So, Stephen, I was talking to a strategist recently on the show, very bulled up, Stephen, on the big banks. And I asked him why, and he said, listen, I just see strong balance sheets. I see relatively attractive valuations. I see a way to sort of just avoid the worst of the tariff ripple effects. Would you agree broadly with that, Stephen?
Hi, Josh. Yes. Well, most of that is true. Obviously, valuations not stretched here, certainly compared to other areas of the market. Tariffs, I think, are a huge wild card for banks. It's more likely that they face some, considerable weakness here. Banks are integral to the workings of the U.S. economy, global economy. Things like trade finance. This is where banks are, major sources of financing, letters of credit, short-term inventory financing, and the like. So, things like that. Higher inflation is going to be detrimental on customers. That could lead to higher delinquencies and therefore credit costs. So, there's some real risks here for banks, and I think that's why we saw a big drawdown last week, down 14% for the diversifieds.
Stephen, it's Julie here. If there is this sort of weakening loan growth related to some of these trends related to tariffs that you're talking about, what are we going to hear from the banks in terms of loan loss provisioning? How do you think the size of that hit is going to be, especially when you compare with past sort of crisis periods like the beginning of COVID, for example?
Yeah, hi, Julie. So obviously, loan loss provisioning can be a very big swing factor for banks. And I think it's too early to say whether they're going to, for the first quarter at least, take big reserves. most of the commentary up till now has been that banks do see a little bit weaker economy in 2025. They have put aside or reserved enough for a kind of this 5 to 5.5% unemployment rate. We're at 4.2% now, so there's a fair amount of leeway in there. So I suspect they'll talk about that in a constructive way in terms of increasing it modestly, preparing for a weaker environment, particularly in the second half of 2025, and try to get ahead of that, so they have enough in the allowance for loan losses to cover those credit costs.
See, I'm just curious if the economy does weaken in 2025. In your coverage universe, Stephen, are there certain names that would be relatively more shielded than others?
Well, we think that those that have some offsets, and there are some in the diversified banks. If you have a J.P. Morgan, you've got a much larger diversification of revenue streams of Bank of America as well. Some of the companies that we haven't talked about capital markets revenues, but clearly the confidence of CEOs and those bringing financial products to market, M&A activity, IPO activity is likely to be sluggish. So that kind of rules out in favor of the Morgan Stanleys and Goldman Sachs of the world. Or the strong regional banks, those with pretty solid territories like a Truist Financial, a PNC, a U.S. Bancorp. Some of these companies have really been hit hard, and I think will not face that same kind of big downturn that the stocks are implying.
Stephen, ultimately, you have buys still on most of your coverage universe, if I'm not mistaken. So does that imply that you think right now could even be a buying opportunity, and that ultimately these companies are going to sort of recover in the coming months? How is this all going to play out?
Right. Well, I think if you look at back to valuations, that they are attractive here. Dividends are 3.5% and 4% plus. That's pretty favorable. I think there will be some offsets, particularly for the diversifieds. Again, not so much in the capital markets activity, but the trading volumes have just been phenomenal. I think we're going to have a record second quarter here in terms of just the volatility that not just across stocks, but against fixed income, currencies, commodities. So that's a big revenue line item for them. And I think one thing that investors seem to have overlooked, at least, and I don't think banks in terms of valuations ever got credit for, was the potential tailwind for reduced regulations, capital requirements getting reviewed. We have a new vice chair of bank supervision, Michelle Bowman, that has been on record that the Basel III increase, endgame requirements are likely to be pared back. So that's pretty good for capital returns, share buybacks, and dividends as well.
Stephen, it's going to be a very interesting reporting season, however way you slice it. Thanks so much for joining us.
Thank you.
Let's do a quick check of the markets here as we count down to the closing bell, and we have seen things really deteriorate across the board for the major averages. All three major averages are now lower. The Dow down by some 770 points or so, a drop of 2%. The S&P down 2.8%. The Nasdaq leading declines now, off by 3.4%. Coming up, we'll get to the latest on President Donald Trump's policy threats as the White House has confirmed 104% tariffs on China coming as of midnight. Stick around, much more market domination still to come.
The White House to move forward on adding a 50% tariff on Chinese goods, a move that would bring the overall tariff rate to 104%. The full tariff rate set to go into effect at midnight. For more on the new age of trade, let's get to Eswar Prasad, Cornell University professor and author of The Future of Money. Eswar, it's good to see you. So President Trump's next tariff deadline approaches here. Eswar, the U.S. does seem intent on moving ahead with these tariffs on China as high as 104%. It sure doesn't sound like China is interested in backing down. They're talking tough right back. How do you see this evolving from here, Eswar? How does this play out?
Well, Josh, Trump is clearly on the war path here, and he seems to want nothing less than unconditional surrender. And troublingly, he has made it pretty clear that whatever the negative effects on U.S. financial markets and the U.S. economy, he's not going to be deterred in his tariff fight against China. So if you look around the world at what the responses are of different countries to the US tariffs, it's a combination of retaliation with their own tariff and other measures, some degree of mollification to try to appease Trump, and then policy adjustments domestically to try to make up for the loss of exports to the US in particular. Now, China clearly cannot, given its internal political dynamics, be seen to be backing down entirely. But I think this comes at a very difficult time for the Chinese economy because domestic demand has been very weak in China. The economy seems to be stabilizing, but is clearly not on a firm footing yet. But this is certainly going to throw up a huge wall to trade and financial flows between the two countries. And I think we're coming to a new baseline where the relationship between the two countries is going to be very difficult to mend. So it's not clear what the off-ramp is going to be, but given the damage to both economies and given that Trump says he's waiting for a call from China, I hope that there will be some meeting point.
And I think, Eswar, part of the confusion is what the goal is. In other words, when you talk about surrender, it's unclear what surrender would even look like, right? Vietnam, for example, came and said, okay, we won't charge you any tariffs. And the administration seems to have said, not good enough, right? And I'm reminded of an op-ed that Oren Cass, who is an economist who is in favor of a baseline of tariffs, wrote about today in the New York Times, where he said the problem is we don't know what the goal is, what the vision is here. Do you agree with that? And what should be the stated goal here?
You're absolutely right, Julie. I spoke about unconditional surrender, and it's far from clear what the terms of that might look like, because Trump in the past has talked about using tariffs as a very broad policy tool, not just to remedy trade deficits, which he invariably sees as signs of other countries cheating, but also he views it as a way to accomplish other policy objectives, limiting the flows of illicit drugs, illegal immigrants to the US and so forth. So what exactly he would want from China is far from clear. But I think from past behavior, one can argue that what China may need to come up with is a package that allows Trump to declare victory. So what might that package look like? Some sort of commitment to buying more goods from China. They tried that in the first Trump administration, so it may not have that much credibility on this round. But also other measures that Trump has talked about, that China says maybe it's going to take very aggressive steps to limit, any prospects of fentanyl getting from China to the U.S. and so forth. So, so far we do not have clarity, and I think this is where both parties coming to the table might be really important in figuring out exactly what it is that Trump would want that would allow him to declare victory and to de-escalate on tariffs.
Eswar, if I'm an investor and I'm listening to this, I got capital committed to, a big, well-known American tech company, for example. How concerned should I be, Eswar? What should my level of worry be that Beijing could go after a big American tech company in some way, retaliate through that channel, like an Apple, for example, or others?
So the U.S. does not, the U.S. does have significant exports to China, but that's only one of the choke points. The others are precisely what you referred to, George. There are many American companies that still get a significant portion of their revenues from the Chinese domestic market that use China as an important part of their supply chains. And even if they don't have supply chains running through China, they need things that only China can provide them right now, in particular rare earth minerals that are very important for production of many high-tech goods, including some military-grade equipment. China has already taken steps to restrict the export of rare earth minerals. Now, it's not that the U.S. doesn't have rare earth mineral deposits, but the process of extracting and processing them is very environmentally toxic, and China pretty much has a monopoly on that right now. So there are many ways in which China can inflict pretty targeted and significant pain on the U.S. economy. The problem that is out there right now is that none of this seems to get through to Trump. The fact that you have financial markets reeling, that you have many parts of the economy, including agricultural producers and many other constituencies that you would think of as important parts of Trump's political base, none of their screaming does seem to be getting through to Trump at all. So the big question is, what is it that China can do to allow Trump to declare victory in some other way?
Ezra, always great to see you and to have you on the show. Thank you for joining us.
My pleasure.
And while wrapping up today's Market Domination, don't go anywhere. We've got you covered with all the action. Following the closing bell, stay tuned for Market Domination Overtime.